Hey everybody, it's Alejandro. It is Friday, September 26th, and a quick market update to let you all what's going on in the world of mortgage. I know that there was a lot of news last week and a half about the Fed cutting rates. Posted a video on my socials just kind of letting everybody know to prepare for the fact that rates might go up because in our side of the world with mortgage, we know that the Fed doesn't control mortgage rates. It never really has, but it does basically serve as one small piece of a larger puzzle. When the Fed announced rate cuts, we saw rates go slightly up, and that's kind of where they've stayed. Right now, the national average is somewhere between 6.3 and 6.4 range, give or take. Obviously, there are a lot of other programs. We've got our home run program that's somewhere around 5.8 to 6%. That one does not have mortgage insurance and also has better rates than any of the other programs, but of course is tied to where the property location is. And so I wanted to reach out and kind of let everybody know what's going on. We're going to take a quick look and then I'll let you get on your way so that you can enjoy your weekend. I'm sure many of you are getting ready for your open houses. So here we go. All right, everybody, this is what I wanted to show you. This is essentially the mortgage bond securities dashboard over the course of the past 3 months. You can see that over the past 3 months, there has been a lot of improvement. We got almost all the way up to 6.125. I think that's actually where we got. But this is right around the time that the Fed cut rates. And then we saw the negativity come in right after that. But you could see at the beginning of September of 2025, we were at about 6.5. Market started coming down and we got to, let's see, 6.13% as a national average, which was phenomenal. We all thought that they were going to go even lower. They had been talking about the Fed cutting rate. But by the time we got to this point, the market had already adjusted because they had expected that rate cut was going to happen. And a lot of the times when the Fed cuts rates, you're really not sure what's going to happen. I try to tell everyone that there's a possibility that rates will go up. And that's what happened this time around. I happened to be right. And rates did tick back up. You know, they came up to 6.375 and they've basically been there now for the past couple of days. Right now, the national average you can see is 6.38%. Now, I know that a lot of you are very well aware of all of this stuff, but I try to be as, helpful as I can to everyone. What does this mean to us? What does this mean about where we're going? I continue to say the same thing I've been saying for a really long time, is that there is extreme volatility right now in our economic markets. There are a lot of economic reports that we depend on, things like job reports that have been showing negative trends over the course of the past several months. That is what led rates to drop. The job market was so bad that it kind of signaled a bad economic turn. And unfortunately, that's kind of what we need in the world of real estate and mortgage. If you're hearing that the stock market is booming and that the economy is doing great, that usually means that inflation is on the way up. And that also means that rates are going to follow them on the way up. And so unfortunately, that's kind of what we need. We need the market, or we need the economy to do poorly, or we need reports to show that the economy is doing poorly in order to see interest rates come down, because that's the only way we're going to get inflation under control. It's not the best news. It's not necessarily what we want to hope for, obviously, but that is the reality. That has been the truth for a very, very long time. Unless the government steps in and buys mortgage bond securities again, like they did during COVID, we are going to have to rely on economic reports that show inflation is on the way down. And generally, in order for that to happen, we need to see job reports trend in the negative direction. I hate to deliver the news. I hate to be the person to say that, but that is the reality of the situation that we're in. For all of you out there that are, that have buyers, I think that it continues to be a pretty good thing for them because they continue to have leverage. I've had a couple of deals come in this past week and the week prior when rates were getting close to that 6.1 mark. And those came in with no seller credits. They paid title policy, but they were the first ones I had seen in a pretty long time that had absolutely no credits from the seller because there was a bidding war and the seller didn't have to. And so I was surprised at how quickly that showed up. You know, being at 6.1 and there's already people fighting over a house. I know some of you are experiencing it out there, but it hasn't been the norm. And so there's definitely that other side of the coin here. As rates go down, I think it's going to blow up really fast. I mean, I don't think we need rates to get down to 3 or 4% to see an enormous uptick in mortgage applications or in home buyers. So get ready because rates can, change on a dime, and we'll continue to watch. We'll continue to see what the market is telling us about what projections might be. But for now, I am going to cross my fingers and my little toes and hope for the best. Hope that we have better, stronger, lower interest rates coming in the near future. But of course, we'll continue to update you and send these little market updates. We hope you find them helpful. And I hope you all have a beautiful, wonderful weekend. Good luck out there, and I will talk to you all soon.